Hello everybody, and once again welcome to Sinhanomics, the money machine. In my last video I did talk about the opportunity, or the lifetime opportunity I should say, in investing in the fastest growing economy of the world, and that was India. I'm sure many of you must have watched that, and I've got plenty of good comments on that as well. If you have not looked at it, I'll recommend you should go and look at that, and then you'll actually appreciate what I'm going to cover today. So well guys, at the end of the video I did talk about the most precious companies of India. I call it Nav-Ratna. In Indian language that's the 9 gems, and one of them is Nestle India. Well, you have guessed it right, I'm going to cover today Nestle India. Well, as the name implies, Nestle India is a subsidiary of Nestle SA. That's a Swiss multinational food and drinks conglomerate. It's incorporated in Switzerland, by the way. And it has been the largest publicly held food company in the world. And Nestle India, as I mentioned, is a subsidiary of that with a market cap of around 2.32 trillion rupees. And if I convert that in US dollar, it's around $28 billion. Well, as you know, India is almost the 5th largest global economy and is 1.4 billion consumers. Yes, you heard that right, 1.4 billion consumers, and actually for Nestle, 487 million addressable consumers are there. So it does open a big opportunity for companies like Nestle. And let's look at a little bit about the result it just announced, the Q3 FY24 result it has just announced a few days back. So I will analyze those results, and then I'll talk about the ratios as usual, and then I'll cover the market share and why this is one of the most prestigious companies of India and well regarded from the food and drinks processing conglomerate. Well guys, I will talk about the Indian rupees in the crores and all those, and I'll also try to convert that in US dollar. Having said that, just for your information, $1 billion US dollar is almost equivalent to 800 crores. So if you look at Nestle India for an example, the price return, as I told you, is $28 billion market cap. And if you look at the price return, the return on the price improvement actually is pretty much year to date, the price has gone up 23%. For 5 years, the price has increased by 135%. And in 6 years, it has been a whopping 240% increase in the price. Well, it's a multi-bagger. That's what it's called in India. And just to put things in perspective for you, in October 2017, this stock was trading at 7,000 rupees. And last Friday, it has closed at 24,057. Yes, over 24,000. So it had a journey of 7,000 to 24,000 in 6 years time, guys, and that is 3.5 times the price has increased. Well, by all means, it's one of the valuable company, and with the growing population and the consumer base in India, this offers a huge opportunity going forward. Let's analyze the financials. As I told you, we'll start with the Q3 FY24 results. So a few days back, actually it announced that result, and the revenue, the quarterly revenue was up 9.5% to 5,070 crores. If I convert that in US dollar, that's $6.5 billion. This is the first time Nestle has closed 5,000 crores in the quarter. So it's a 20,000 crore company. In US dollar, is, as I told you, is pretty much 26 or $22 billion revenue annualized. And you can actually see the price to sales ratios quite comfortable. The market cap $28 billion and the revenue or the sales $22 billion. So it's really cool. In fact, it's $26 billion if I'm not wrong. If I just annualize it based on this quarter's revenue, 6.5. Well, from that perspective, it's a great company. And if you look at the other, like EBITDA, for an example, is up 20% year over year. Guys, it's 1225 crores. And then in the net profit perspective, again, it's up 37% to 908 crores. In US dollar, it's around $1.1 billion. And the market expectation was around 800 crores, by the way. Just $1 billion. It has beaten the market on the EBITDA front. It has beaten the expectations on the net profit perspective, and also from the margin perspective, it has a margin of 24.3%, much higher than what the market was expecting, and that was 23%. So, well, it's really a cool company giving 24% margin, and one of the largest company in India. It's part of the Nifty 50, by the way. From the dividend perspective as well, it actually gives a huge percentage of its profit as dividend. This financial year, it has already paid 242 rupees. Yes, and that includes the 140 rupees announced just a few days back with the Q3 result. And guess what? That's all interim dividend. It's not final yet because the financial year has not closed. So you may expect another 1 or 2 dividends coming there. So with something like not very high dividend from the yield perspective, it's around 1.2% or something. But if you look at the other financials, I will cover that in a minute, you will be shocked to hear that. Well, another important thing is that the company also announced a share split 1 to 10. So that means one share will be split into 10 shares to increase the liquidity, of course, so that the retail investors can find them affordable. Right now it's trading at $24,000. Not many retail customers can actually buy that. So once it gets split into 10 shares, it will be trading at around $2,400, and that will be pretty comparative to the other companies like Hindustan Unilever of the same segment, which is trading at around $2,800. Well, let's move on and look at some of the financial ratios. Again, let's start with the price earning ratio. I will little bit explain what are these ratios, but I think most of you are aware of that because we have been covering this for the last many videos. Any company I cover, I do cover the financials, I do cover the balance sheet ratios, cash flow ratios, etc. So from the price earning perspective, Nestle is trading at around 78 to 80x. Yes guys, it's expensive from that perspective. And if I give you a comparison of the other companies, for an example, Britannia is trading at around 56 times. Hindustan Unilever is pretty much trading at around 56 times as well. And I beg your pardon, Britannia I think is around 51 times. So they are at 50 to 60 range, and this is trading at around 78 to 80. So as compared to the peers, this is slightly expensive from the price earning perspective. Again, from the price to book ratio, P to price to book ratio, it's at around 80. And if I compare that with the key competition here right now, Hindustan Unilever is at 12 and Britannia is at 31. So both from the price earning ratio and from the price to book ratio, this seems little bit expensive. But having said that, this company has always been expensive, guys. People who have missed this opportunity just looking at these price earning ratios, they have missed a big run that I talked about from 7,000 to 24,000. 3.5x. Again, if you look at the ROC, return on capital employed, you'll be surprised to know it's at 138%. Means $1 capital employed actually generates $1.38 of profit. And guess what? This is the highest ROCE among the Nifty 50 companies. Yes, you heard that right. From the ROCE perspective, Nestle is delivering the highest ROCE in the whole Nifty 50 companies in India, as compared to the peers. For example, Britannia has an ROCE of 48% and Hindustan Unilever HUL is at 27%. So you can see that 138%, 48% and 27%, guys. It's a cash churning, profit churning machine. Well, if I give a little bit of a color to the ROC for some of you who are new to this world, ROC is primarily measured, it's kind of a measure of how efficiently a company utilizes all available capital to generate additional profits. And that's what I told you. For every $1 capital, it's actually generating $1.38 of profit, additional profit. And I'll cover the return on equity shortly, but it can be compared with the return on equity. If you look at the return on capital employed, it's actually EBIT divided by the capital employed, total capital. EBIT is earning before interest and tax. So ROC equals EBIT divided by the total capital employed. Very close to the ROE, which I'll cover in a minute. And as I told you guys, this has the highest ROC in the Nifty 50 companies. Well, let's talk about return on equity. That's another great measure for fundamental analysts to measure how efficiently the company generates profits using the funds provided by the shareholders. And return on equity is pretty much equal to the net profit divided by the equity, shareholder equity. And you will be surprised to know that the ROE also is the highest for Nestle out of all the Nifty 50 companies in India, and it's at around 108%. Yes, you heard that right, 108%. So $1 of the fund provided by the shareholder is generating $1.08 of profit. And if you compare that within Nifty 50 world, Britannia is number 2, that is 66%, and TCS, Tata Consultancy Services, that's at around 47. When you compare the peer group with Hindustan Unilever, which I have been comparing throughout, because in this segment, in this FMCG segment is called fast moving consumer goods. In this segment, Nestle, Britannia and Hindustan Unilever are the key players, guys. And when we talk about ROE, again I'll repeat that Nestle has 108%, Britannia has 66% and Hindustan Unilever has 20%. So now you can also see and you can actually analyze that why this company is trading at a much higher price earning ratio and price to book ratio, because it's giving you the highest ROC and highest ROE out of all the Nifty 50 companies in India. Well, if some of you are interested in the ROA, return on asset, is pretty much at 28%. Again, is very high. And Britannia is at 24% and Hindustan Unilever is at around 14%. If you consider the debt to equity ratio, how much debt the company is having, the debt to equity ratio is 0.1%. Guys, almost it's a debt-free company because it does have something like 60-70 crores in the cash. So it's pretty much a debt-free company. It's a cash-generating debt-free company, you can say that. As compared to Britannia, for an example, Britannia debt to equity ratio is around 0.85, and Hindustan Unilever is also at around 0.03. So all these companies are virtually debt-free companies. Britannia is the only one which has slightly higher debt, but they are trying to expand aggressively in certain segments. So when we look at the financials, its results was fantastic. When we look at the different ratios from the fundamental analysis, they are doing extremely well. Guys, a no-brainer. If you need to have one company in the FMCG space in India in your portfolio, it should be Nestle. And that's my personal opinion. Of course, you should be consulting your financial advisor before making any investment decisions, my friends. Well, let's look at the market share. And almost in all the segment, for all the products it's offering, it has a market share of more than 50% in India. Let's look at some of them. Nestle actually leads the baby foods like Cerelac. Nestle Cerelac has a market share of 97%. It has a monopoly. Almost every kid in the urban space, I would call it, born in India actually consumes Cerelac. Again, instant pasta, 76% market share. Condensed milk, 70% market share. Lactogen, that's another one for the kids, baby food. They have 66% market share there as well. Instant noodle, guys, Maggi noodle and all those are actually Nestle's product, and they have 60 to 65% market share in India with this kind of population. Instant coffee, Nescafe and all those, it's pretty much 51% market share. Nestle Everyday, that has 44% market share. And Nestle Ketchup, that's picking up as well, that has 20% market share as well. So you can see that in all the product it has a market share of more than 50%, and some of them are pretty much like 70 to 80% and 97% for Cerelac, guys. Well, needless to say how important this company is for a country like India with such kind of growing population, and that's why it's in one of my Nav-Ratna, or the nine gems of India. Well, 95% of the business comes from domestic market. Only 5% gets exported from India market for Nestle. And the reason is very obvious, because it's a subsidiary of Nestle SA. So only those products which are only manufactured like Cerelac and all those baby foods that I talked about get exported. And let's look at the future scenarios, future prospects actually. So this Diwali, which is coming, all the festival seasons are coming right now. In fact, after 2019, this is the first Diwali or the first festive season where there will be no shadow of the pandemic COVID. It's a clean year. It has been a clean year, touch wood. Market is looking good, pretty much at the extreme record high in India. But a little bit of concern is there because of the food inflation. We all know that in the whole world inflation has been pretty high, and food inflation has been picking up, and that's kind of a alarm for Nestle. Having said that, the next big thing Nestle is working on is the packaged food. Yes, you heard that right. Packaged food market is not yet penetrated in India, and if you look at the total market in India, for an example of the packaged food, is like $800 billion. The total market is $800 billion, and out of that, packaged food is $100 billion. And Nestle is trying to get the market leadership position there as well. And if I give you some perspective of how India packaged food market versus others, China for an example, The per capita packaged food consumption is 4x, 4 times more than India. Even in country like Philippines, per capita packaged food consumption is 3x, 3 times more than per capita packaged food consumption in India. And this gives you an idea that how large is the opportunity here. And Nestle is trying to get into that. Again, the other big area Nestle is working on is in the rural segment. Actually, they call it Rurban, R-U-R-B-A-N. It's a combination of two words, rural and semi-urban. Rurban. So it's trying to actually grab the market share or expand it in that space. Right now, it has a market share of 20% in the rural India. And Nestle has been growing in that sector pretty much 25 to 26%. So you can actually see if the growth is at 25%, 26%, very much in 3 years' time, it will double its market share. So once it has a 40% market share, you can imagine what will be the price and the profitability for this company. Well, I think I've given you enough information about this company Nestle. In my personal opinion, it's a must-have in your portfolio, and that too in the long-term portfolio. And once it splits, 24,000 share becomes 2,400. After 1 to 10 split, you will see the huge influx of liquidity from the retail investors. Well, if you don't have this share in your portfolio, maybe it's time to think about it. Having said that, guys, don't forget that all this information is for education and entertainment purposes. Education for the guys who are already into share market, and it's entertainment for somebody who's sitting on the side and watching the fun. That said, all the stock I talked about, including Nestle, was my personal opinion, and don't forget to get your financial advisor's advice before making any investment decisions. Remember, Sinhanomics is out there to create financial awareness so that you can learn how to analyze a company and make informed decision and make money. If you like this kind of contents, please don't forget to like, share and subscribe. I'll be back with another company very soon. Till then, it's a goodbye from your finance coach, Pankaj Sinha. Bye-bye.